Crypto holders, something extremely unusual is unfolding beneath the surface, and the more you look at it, the stranger it becomes. Bitcoin's recent drop wasn't just another painful dip. It behaved like a collapse caused by an unseen force. A force so large that the market still hasn't fully absorbed it. There was no government crackdown, no industry scandal, no global financial shock, yet the price fell as if the entire system had been hit with a sudden internal rupture. That kind of movement only happens when someone with enormous influence loses control of their position. Quietly, in private groups and analyst circles, the same theory keeps emerging. A major player got wiped out. Not a retail trader, not an influencer with a leverage addiction, but a heavyweight with billions tied up. The kind of institution whose collapse doesn't produce headlines immediately because they unwind through private channels rather than public markets. When these giants fail, their selling isn't loud and chaotic. It's slow, mechanical, and relentless. And that's exactly what we've been witnessing. Daily waves of pressure that seem too organized to be fear-driven, too consistent to be coincidence, and too focused on Bitcoin alone to be a market-wide panic. What makes this even more interesting is the behavior of investors during this downturn. Normally, when Bitcoin crashes, it drags everything else down with it. But this time, certain parts of the market showed surprising resilience. That suggests the broader industry isn't losing confidence. Instead, it's bracing for the end of a single forced liquidation. It's almost as if the market is waiting for a thunderstorm to finish before stepping outside again. And historically, when Bitcoin goes through this type of squeeze without a fundamental reason, the aftermath is explosive. Another underappreciated detail is the role of miners during moments like this. They are the backbone of Bitcoin's supply, and unlike traders, miners make decisions based on production economics, not emotion. When the price dips near their cost of operation, they stop selling and start holding. Their behavior often creates a natural floor that big investors quietly pay attention to. It's a simple rule in commodity economics. The cost to produce something tends to define the deepest level it can fall before the market pushes back. Bitcoin has repeatedly proven that pattern true, even during extreme events like the 2020 crash and the FTX wipeout. The psychology of the market also plays a massive role. The most dangerous part of a downturn isn't the price drop, it's the waiting. People can handle a fast crash. What breaks them is the slow grind, the uncertainty, the constant feeling that maybe it will get worse. That's why long consolidations are infamous for flushing out even strong believers. But ironically, these drawn-out periods often set the stage for the most powerful recoveries because only the patient remain. If this downturn really came from a single collapsed entity, not from weakness in Bitcoin itself, then the moment that forced selling stops, the entire structure of the market changes instantly. Liquidity returns. Confidence returns. Buyers who stayed silent suddenly step in, and Bitcoin has a long history of snapping back harder than anyone predicted once the pressure lifts. Right now, the smartest thing anyone can do is stay aware, stay calm, and stay ready. Because when the true cause of this drop finally comes to light, the entire market will understand what really happened. And by then, the next major move may already be underway.